Holy smokes! Tom Lee dropped bombs for investors today on CNBC, and you need to hear this.
Yes, that feels investors are still too cautious, but he thinks that the fear of May or the sell in May and go away will turn into buy in May. Tom Lee is managing partner, head of research at Fundstrat Global Advisors, as well as a CNBC contributor. We'll never forget the call that you made, and it was one of many pretty good calls, but it was what the S&P was going to do near term based on inflation not being as bad as what was built into the market. And I think you're kind of returning to that theme, and I'd like to know why you think that. What do you know about inflation that the market doesn't seem to understand right now? You don't think we need to be as hawkish as we are?
Yes. A lot of it has to do with why CPI has remained stubbornly high. Powell talked about it, that there's this residual lag associated with housing. So even though home prices are stabilizing and rents are actually getting back to sort of traditional rates of growth, it's still reported in CPI at close to 6%. And then the second piece is auto insurance, is what Powell calls non-housing services. Auto insurance is rising at 21%. Now, a lot of that's because auto insurance rates are actually jumping, but that's not going to keep going 20% forever. Once that starts to normalize, then you can think about what median inflation is, which is running at 1.8%. So I think inflation's going to sort of cool pretty dramatically. I don't know when, but it'll be sometime in the second half of this year.
I think you, maybe a couple months ago, you weren't quite as bullish. I'm not sure what your reason, but you came on and said it might be tougher going. And we did have a series of inflation numbers that were hotter than people thought.
Yes.
Did we not?
We did. I mean, yes.
Yeah, and that you think that's not going to be the case as much from here?
That's right. I think going forward, a couple of things are better. One is like this job market isn't so red hot anymore. So I think the Fed's not on its heels as much about, inflation could fall. And then I think that the things I mentioned, housing and auto insurance, are going to start to cool. So inflation prints start to look better. And we know that we had a big reset in April. So I think it looks pretty good for now.
You must agree, I guess, that the Fed right now is in restrictive territory. Because I've been amazed at how the default position for Jay Powell has been for weeks and months that we need to cut eventually. He never even... It seems like the idea of hiking has never even crossed his mind, and he took it off the table again last week, basically. But it's weird to me, with the economy as strong as it was and inflation as sticky as it was, I don't know why that was his default position. I don't know why he just wasn't more asymmetric or symmetric. I don't know why he just didn't say the risks were symmetric both ways. He seems so sure. He's jonesing to cut rates. He really wants to, and the market believes him. And every time he says it, the market rallies and gets ahead of itself.
Yes. I mean, my sort of guess is I don't think the Fed's that comfortable with long-term rates at these levels. It is quite high, and as you know, it's putting a lot of pressure on regional banking. It's really hurting their balance sheet. The cost of money is quite high, especially relative to the rest of the world.
And you think we are restrictive?
Yeah, I think it's quite restrictive, yeah.
You do. And you notice whenever we return to, okay, we're still doing cuts, and then Bitcoin goes. That's all it takes, right? The minute it looks like the printing presses are going back on, it goes. So you're still bullish. It's back to, I don't know, it was 50. I think it was at 57. It's back to 65 before you can blink. That's right.
I mean, Bitcoin's still, we think, early in an upcycle. So the idea that it could get to like 150,000 this year is still, within our base case. And
150,000 in 2024 is your base case. Okay. All right, go on. I didn't mean to. Yeah.
Go on. Go on.
Yeah, go on. Don't stop.
Yeah. I think it does help that the Fed is reiterating that its view on the inflation and its being relatively dovish is more dovish than where the market is. So I think that's the process of why markets are recovering.
Because I know when they told me wrap it up, and people always get mad on. You say you're going to come on Twitter, and everybody gets excited. and then you're never on long enough for these people on Twitter. Should I pay attention to
Can I
them?
just ask one more?
Yeah, please.
And it has to do actually with what I saw when I was in Omaha this weekend with Becky. You know, one of the things Warren did was he trims this Apple piece. And I think underneath a lot of the language that he spoke about for 5 hours, there was some anxiousness about the overall economy. You don't have that anxiousness. He's in there, has this massive portfolio, sees everything. What do you think of that?
I understand where he's coming from. I think if someone said, what are they anxious about? It is the fiscal deficit, the size of the deficit.
I'm not even sure he's anxious about that, though. I mean, he's anxious about that long term, but he was even asked about that, and that was not his issue. I think his issue was fundamentally, I don't want to put words in his mouth because he didn't say it. There's a lot of tea leaf reading, but just about the strength of where the market is right now and whether it's potentially overpriced.
Well, you know, he's steering a huge ship. So, you know, he has to think in, you know, longer term. But to us, earnings growth is accelerating. You know, Q1 earnings are up 7%, but, you know, 3 groups are down 20%. You know, energy, healthcare, materials. Those energy and healthcare flip to positive next quarter. So earnings growth hits 11%. We know there's a lot of pent-up demand. Capital spending is picking up, and the ISMs are turning up, and there's $6 trillion of cash on the sidelines, and people have been cautious for more than 2 years now. So I think the risk reward's still pretty good. You know, I don't know if maybe Warren's lens is more 10 years out, and that's when you can be cautious, but I think the next year looks good.
So Tom Lee basically said today that inflation is going to fall or plummet, as he used, later this year, and that's why you need to be bullish on stocks now. That is something the Fed also referred to in the latest FOMC press conference, that rent inflation will likely get into the data, meaning that the inflation that you're actually seeing in renting markets in the US is back to a pre-pandemic level, but it's still showing up in the CPI data as very elevated. The belief is that that will start to cool down later in this year, and if you are a viewer of this channel, you know that Allstate just reported that they're not going to be raising premiums as much as they did previously because their profitability is improving. That is something that Tom Lee pointed out to us about 2 days ago over on X. And that's another reason to hit that like button and subscribe to the channel so you don't miss anything that can help you make money. I do personally think what Tom Lee said today makes a ton of sense. I do believe, though, let's just be honest, the NASDAQ is pretty expensive. The S&P is pretty expensive. Do I think there's a ton of upside there? Not really. But if we do have a strong economy, or at least a decent economy, a normal pre-pandemic trend-like economy, an economy that's not heading into a recession, but maybe not overheating, and you start to get rate cuts from the Fed, well, that's a recipe for small caps to really start to outperform. And that is the specific index that I am super bullish on. Let's just be honest, I'm super bullish on small caps from here. I think the risk to reward makes a lot of sense if indeed we do avoid a recession. Now, if we go into a recession, everything's going to do poorly. So it really doesn't matter whether you're in the NASDAQ, small caps, S&P, single stocks, ETFs, doesn't matter. If you go into a recession, everything's going to do bad. But if you are in the soft landing camp, category, if you will, or no landing at all, no recession at all, then I think the Russell is probably where you want to be allocated to right now. If you're already not allocated to stocks in a substantial enough way. If you do take a look at the Russell 2000, specifically at your major moving averages, I consider your major moving averages your 20-day moving average, your 50-day, your 100-day, and your 200-day moving averages. You're above all of these major moving averages right now. That likely means a strong bias towards a continued upside move from here. In fact, take a look at what you've seen around your 50-day moving average on Friday. You held support in the body of the candle on Friday at that 50-day moving average, and today you essentially gapped up higher. And the low wick of today's candle is very small. That means you've seen a minimal drop today And then the Russell just really took off. And now you are, well, getting further away from your 50-day moving average to the upside. And this can likely continue leading the Russell into the teens here coming pretty soon. And it's pretty similar if you look at the NASDAQ. The NASDAQ is well above its 200-day moving average. 100-day moving average, you were actually under this in recent weeks, and now you're above that. You're also above your 20-day moving average by a pretty good margin. Your 50-day moving average on Friday was resistance, and you actually got rejected there. Here you can see the 50-day moving average is this purple line. You got rejected on Friday, and then what happened today? You gapped up above your 50-day moving average. You did fall initially in the trading day to a low of about $436.50 or so, still holding above your 50-day moving average. And what happened? The NASDAQ took off today. That's a pretty strong sign as well that you're likely going to get further upside from here in the NASDAQ. For an example, the last time this happened was back here on November 3rd, where you found resistance at the 50-day moving average. Next day you gapped up, and what happened? You continue to rally, and now it just happened again. And if you take a look at the NASDAQ's RSI, it's at 56.5, so there's definitely some room to run before you get close to 70, and you're getting close to that overbought level. Same is true for IWM, the ETF for the Russell 2000. That RSI is at 58.65, so definitely could see some more upside pressure on the Russell and the NASDAQ before you're overbought. Today, right at about the time you guys are likely watching this video, you are going to have some earnings coming out with Palantir, Symbotic, Lucid Realty Income, Hims and Hers, Rocket Lab, Microchip, Axon, Teradata, and Coherent. Microchip and Coherent, these are AI semiconductor companies. They could affect ARM that reports earnings Wednesday and after hours. They could also affect NVIDIA if there is really bad or really good earnings. And then obviously Palantir can be important for your AI trade and really software companies as well. Throughout this week, you're going to have other big earnings like Disney tomorrow pre-market. You're going to have Crocs, Datadog, Celsius, Ferrari, BP. Tuesday after hours, Rivian, Arista, Upstart, Lyft, Oxy, Twilio, and Toast, as well as Wynn Resorts. Wednesday pre-market, you have Uber, Shopify, Affirm, ACM Research, Toyota, Emerson, Perion, and that's pretty much it. Wednesday and after hours, you do have ARM, which is probably going to be the earnings that moves the markets the most broadly. So that's definitely one to keep your eyes on. The stock's fallen a lot. I think you've priced in not great earnings, but we'll kind of have to wait and see. The valuation on ARM is still stretched. But given the recent price action, I don't think there's reason to be too concerned with what ARM is going to report. Then again, I don't have the report in front of me and I don't know what it's going to be. So there's always a chance that it's really bad or just really good. Robinhood will also report Wednesday and after hours, Airbnb, AMC, The Trade Desk, Beyond Meat, AppLovin, Duolingo, and Exact Science. Thursday pre-market, you have Roblox, Warner Bros, Sundial, Plug, Kronos, Canadian Solar, and Cedar Fair. Thursday after hours, you have Marathon Digital, SoundHound, CleanSpark, Unity, Vuzix, Blink, and Indie. And then Friday pre-market, you have a bunch of just random companies. Over on CNN's Fear and Greed Index, you currently sit at 40, which is still pretty fearful. On Friday, you were at 39. So even though you are going higher today in our markets, it's not changing the overall Fear and Greed Index all too much. Now, what I will tell you is this headline number is interesting because if you look at market momentum, that is in greed territory. But look at stock price strength. This is net new 52-week highs and lows on the New York Stock Exchange. You are sitting here at a 0.5%. Basically, no stocks are hitting new all-time highs or 52-week highs. That is an extreme fear. Stock price breadth is in fearful, right? That just means there's not a lot of stocks that are going higher recently. Even when the markets are going higher, it's not like it's a broad-based market rally, aka small caps. A lot of those are not participating as well in our markets. Put and call options, put to call ratio sitting at 0.8. So that is neutral. Market volatility is neutral as well. The VIX, and this looks at the VIX and its 50-day moving average. Safe haven demand is in extreme fear territory. This is the difference in the 20-day stock and bond returns. You're sitting at positive 0.03%. So there is a safe haven demand that has definitely been in our markets. Junk bond demand is sitting in greed territory as well. Your latest AI investor sentiment survey that came out on May 1st that will be coming out here in about 2 days. You have bullish investors at 38.5%, neutral investors at 29.0%, and bearish investors at 32.5%. Something that also did help boost markets temporarily today was Hamas, that says they accept the ceasefire proposal of Egypt and Qatar. But that was followed by Israel's rejection and the start of the ground operation in Rafah that has begun. So markets got temporarily excited that maybe the drama is going to be over for a 6-week period, but, well, it's not. And it actually is prompting Israel to continue with the Rafah operation. At this point, though, I don't see this as something that is massively affecting our markets, but it is having a role to play in energy markets, and that's the important part to be watching. One of the bigger reasons why markets may be doing well today, and very well, is Fed Williams that says eventually there will be rate cuts. There's actually an 8.5% chance of your first cut June 12th, 2024, and a 30.8% chance of a cut July 31st. There's about 12 weeks from now until July 31st. I think we're probably going to get the first cut from the Fed July 31st. We are going to have 3 of everything, essentially. 3 inflation reports, 3 jobs reports, 3 rounds of economic data from now until then. I think by then, by July 31st, that is when the Fed is going to start cutting rates. And with that logic in mind, if the markets continue to price in the first cut coming in July, as I believe will happen over the next 4 weeks or so, then small caps should really start to outperform as long as the economy remains well. Currently, the markets are pricing in 2 rate cuts in 2024, the first of which in September, on September 18th, the next one on December 18th of 2024. I believe it's going to be July, September, and December. It wouldn't surprise me if the economic data starts to look bad and inflation falls, and we could also get a cut in November as well. The short bear over on X makes this post that's pretty interesting I would like to share with you guys. Emerging markets are breaking out. After 3 years of a bear market, we are attempting to resolve higher. Another sign that I want major exposure to emerging markets. And this post from Ryan Dietrich over on X is another pretty interesting one. He says this bull market is still quite young at less than 19 months old. Looking at the past 12 bull markets showed the average is just over 60 months. But 5 of the past 12 started in October, like this one. When they start in October, they last even a little bit longer. The average return of these bull markets caused the S&P to go up 155.9%. The median return is 101.5%. And here is this post from Market Insider that quotes Tom Lee in the article, the video that we listened to today. He says, buy stocks in May because inflation is set to plunge through the rest of 2024. And this could also be another reason why stocks are outperforming today, because when Tom Lee says something, markets tend to pay attention. And that was a pretty strong message to say, hey, inflation is going to plummet. So let me know what you think about all of this information down below in the comment section. Hit the like button as well as subscribe to the channel if you have not done so already, especially if you made it to the end of this video. Thank you for watching. Enjoy your day, and I will see you in the next one.